Welcome everyone, and thank you so much for checking out this video today. My name is Megan Cruz and I work for the Federal Reserve Bank. I'm joining you from Oklahoma, but I really wish that I could meet each of you in person. But since that's not possible, I hope you all are staying safe and healthy during this time. In today's workshop, two primary topics will be covered: understanding credit and saving for college. I chose these two because, well, one, I get a lot of questions from students about them, and secondly, these are areas where, depending on how you approach them, can have a pretty big impact on your life. But before I talk more about that, I need to start by giving you a short disclaimer. The views expressed in the presentation are mine and not the views of the Federal Reserve Bank of St. Louis or the Federal Reserve System. Now that that's out of the way, I want to give you some information about the Federal Reserve. The Federal Reserve Bank, also known as the Fed for short. When you hear the word bank, you are most likely thinking of a place where you can open up a savings account or get money, but that's not what the Federal Reserve does. It's not like a commercial bank or a bank in your community. It's the central bank of the United States. So what does that mean exactly? You may be surprised with how much of an impact the Fed has on the world around you. The Federal Reserve has several primary functions. The first is conducting the nation's monetary policy. This can be complicated, but essentially the Federal Reserve makes decisions and uses tools to promote steady and sustainable economic growth. You may have even heard of the Fed in the news recently, announcing actions to help support the economy during the COVID-19 pandemic. The second function is providing an efficient payment system. One example is something you'll be familiar with. The Fed distributes currency and coin to financial institutions. This means the cash or Federal Reserve notes you get from your local bank come from the Federal Reserve. Not only does the Fed distribute new currency, but they also test used currency to make sure it's fit to return to circulation. If it's torn, dirty, or worn, it is shredded and will be replaced with new currency. Next, the Federal Reserve supervises and regulates banking and financial institutions. Supervising banks generally means helping to establish safe and sound banking practices and protecting consumers. The Fed is also committed to providing personal finance and economic education to the public at no charge. This includes making the content you'll see today. In my role, I work specifically with Native communities and nations. There are 12 districts in the Federal Reserve System, and each is governed by a regional reserve bank. As you can see, many of the districts have branches. You can also see that each district has an assigned number and letter combination. As an example, in the combo 8H, H is the 8th letter of the alphabet. This designates the St. Louis Fed, the 8th district of the Federal Reserve. If you find yourself bored one day, take a look in your wallet. Each note has a letter and number designation that identifies which Federal Reserve Bank distributed the note. In this example at the top, you can see the 8 and H shown separately, which identify the St. Louis Fed. In the example below of a newer note, you see L12, which stands for the San Francisco Fed. You might be surprised by how many reserve banks you have represented in your wallet. I want to give you an overview of what will be discussed in the workshop. It will be divided into 3 sections. The first is the importance of managing credit cards responsibly. This includes tips for managing credit. I can remember after high school being sent credit card applications, which may be something you're already experiencing as well. If not, you definitely will. The second is the importance of credit scores and what they are, along with how a FICO score is determined. The last section will focus on ways to fund higher education. The focus will be on college, but the decision-making process laid out can apply to other paths, such as trade school. Factors to consider when choosing a college, along with investing in human capital, which may be a new term for you, will also be covered. At the end, you'll see my contact information. If you have any questions about what you learned today, feel free to reach out to me. Also, if you're interested in learning more about internships or careers with the Fed, you can reach out to me as well. You'll also see 2 websites, including one called Econ Lowdown. This is our website where virtual classrooms can be created and where we also have personal finance and economic lessons and modules. As I mentioned before, all of our resources are free. With that said, let's get started.
Great pizza.
Is it worth $2,000?
Huh?
I didn't say anything.
I did.
Who are you?
I'm the credit card you just used to pay for that $2,000 pizza.
What are you talking about? It only costs $9.95.
Yes, if you paid it off within the grace period. but you only pay the minimum due. And you've almost maxed out your $500 credit limit, mostly on pizza and other impulse purchases. So, if you just keep paying the minimum, it will take you 267 months to pay me off. And all those little charges will wind up costing you $2,129 based on an 18.9 annual percentage rate.
We better enjoy this pizza. You'll be paying for it for 22 years.
I wouldn't talk if I were you.
Who's that?
Uh-oh. That's my credit card.
That's right. And you owe about $3,000 on me.
That's not so bad, is it?
No, except you only make the minimum payments too. That means you'll be paying for that smartwatch about 2 decades after it's gone out of style. By then, that $3,000 balance will have cost you $12,774 based on your annual percentage rate, which is also 18.9%.
So you're saying we shouldn't use credit?
Oh, not at all. Credit cards are a powerful tool when you let them work for you.
Credit cards are handy and safe for online purchases, and we can be a lifesaver in an emergency. We help you establish the good credit that will help you purchase important things like a car or home.
Use credit within your budget and try to stay away from impulse purchases.
Like food?
And clothes?
It's fine to use us for a special celebration.
Or to buy a suit for an important interview.
But remember to think before you spend and stay within your budget.
Here are some simple guidelines for managing your credit.
It's okay to have credit cards, but manage them responsibly.
And you really need to pay your bills on time.
Keep your balances low on credit cards and other revolving credit.
Pay off debt rather than moving it around to other credit cards.
Don't open a lot of new accounts too rapidly.
And finally, check your credit report often.
Remember, keep your credit working for you.
And not the other way around.
Understanding how a FICO credit score is determined. Presented by Econ Lowdown. FICO is a company that uses statistics and mathematical formulas called algorithms to determine a person's credit score. A FICO score is the most common credit score used to determine loan eligibility and the interest rates a person pays. A credit score is a person's financial history packed into a 3-digit number, which indicates a person's credit risk. Your credit score is compiled of information found in your credit report. A credit report is a loan and bill payment history kept by a credit bureau. Financial institutions and other potential creditors use credit reports to determine the likelihood of debt repayment. Credit scoring companies use statistics to determine the risk associated with lending. They do not use data such as sex, age, race, or religion to determine the likelihood of repayment. FICO and other credit scoring companies are always updating their formulas, but here are the categories that FICO generally includes in the development of its credit scores, with a rough estimate of the emphasis they place on each category. Payment history accounts for roughly 35% of the credit score. The amounts owed relative to credit limits accounts for roughly 30%. Length of credit history accounts for about 15%. Frequency of new credit accounts for roughly 10%. And types of credit used accounts for about 10%. Let's quickly break down each category. Payment history takes into account any bills paid late, including how many are late, how late they are, how recent any delinquencies are, and the total amount owed. This is where people can sometimes find themselves in trouble with credit. The good news is that over time, older entries, including negative entries, disappear from your credit report. Typically 7 years for late payments and 10 years for bankruptcy filings. Amounts owed relative to limits is your debt-to-credit ratio. Say you have 5 credit cards, each with a $20,000 credit limit. That means you've got a $100,000 credit limit. You may only be using 10% of that, and that's positive. However, if that means you've maxed out on one card, that's negative. It's best to keep your debt-to-credit ratio below 50%. Length of credit history takes the average length of time you've had your credit card accounts into consideration. The longer history you have of making payments on time, the better your credit score. Frequency of new credit is important because if you have a lot of newly issued credit in your credit history, whether new loans or new credit cards, lenders may be concerned about your ability to repay all of that new debt. Therefore, they will be less likely to lend you money. While examining types of credit used, lenders prefer to see that you are capable of handling different types of credit. So someone who only has credit card debt will probably not have as good a score as someone who has demonstrated good payment habits on installment loans, mortgage loans, and student loans, as well as credit card debt. All of this is important because your credit score affects your ability to rent an apartment, buy car insurance at lower premiums, and obtain credit at lower interest rates. That's right, a good credit score will save you money. Here's an example. Kim Min-yo and Lee Soo-young are applying for a $10,000 loan. Both look like qualified candidates. They both live in the same city and work at the same company. Let's see if their FICO score tells the same story. Min-yo pays all of his bills on time and in full. He usually uses about 10% of his total credit limit, and he's had the same credit card since college. Soo-young, on the other hand, frequently forgets to pay her bills on time. She uses over 50% of her credit limit, and when she maxes out a credit card, she opens a new account. Who do you think would have a higher credit score and, as a result, be more likely to obtain a loan with a better interest rate? That's right, Min-yo would, because his credit score is closer to 800, while Soo-young's is closer to 600. Suppose that Min-yo received a 5% simple interest rate on the $10,000 loan, while Soo-young received an 8% simple interest rate. Over the course of a year, Min-yo would pay $500 in interest, while Soo-young would pay $800 in interest. That's $300 more interest than Min-yo. She could have saved or used that $300 to purchase something else, so your credit score does matter. Let's recap. To maintain a good credit score, pay all bills on time and in full. This way you avoid late fees. Avoid opening new credit card accounts or installment loans. Keep your debt-to-credit ratio low. Don't cancel your oldest credit cards, as length of credit history is important. And remember, monitor your credit reports. By law, each of the 3 credit bureaus, TransUnion, Equifax, and Experian, must provide you with a free credit report every year. You can obtain these free copies by visiting www.annualcreditreport.com. Remember, each of these reports may vary slightly from the others, so it's important to check all 3. Now you understand a little more about how a FICO credit score is determined. Visit stlouisfed.org and the education resources for more information on credit and other topics. Continuing Feducation, brought to you by Econ Lowdown. Meet Martina Flores. Martina knows that education is important and that it will help her be successful in life. But with the rising cost of a college education, obtaining a degree seems almost impossible. In this episode of Continuing Feducation, we're going to discuss investing in human capital, factors to consider when choosing a college, and ways to fund higher education. Economists use the word investment to refer to spending on capital, which can be either physical capital, such as tools and equipment, or human capital, such as education and training. Investment in human capital is the effort that people put into acquiring education, training, and experience to increase their productivity and earn higher income. Martina is debating between a career as an elementary school teacher or a computer programmer. Either career requires a college degree. She has to decide which career is best for her and what college to attend. There are some important points Martina should consider when she makes her decisions. One source of career information is the Occupational Outlook Handbook on the Bureau of Labor Statistics website. Martina visits the BLS website and learns that in 2012, an elementary school teacher with a 4-year degree earned a median annual salary of $53,090. while a computer programmer with a 4-year degree earned a median annual salary of $74,280. She also learns that the expected job growth for elementary teachers over the next decade is 12%, and for computer programmers, job growth is 8%. Although the expected salary is lower, Martina really enjoys working with children and thinks she would prefer a teaching career. Now Martina moves on to her next decision. What college should she attend? There are some important things for Martina to consider here as well. One is return on investment. Return on investment, or ROI, is a term used in relation to financial investment, such as the purchase of a stock or a bond. Return on investment tells us how well the investment performed. In this case, we use the term ROI to think about the cost of 4 years in college in relation to the potential income that could be earned. Martina knows her expected income from her visit to the BLS site, but now she needs to consider the financial costs of attending college. Should she attend a public or a private university? Between 2009 and 2013, the average cost of attending a 4-year public university, including tuition, room, and board, was $65,238, while the average cost of attending a 4-year private university was $132,853. Given Martina's projected median income, should she only consider public universities? Not necessarily, but she should consider cost. Of course, a lot depends on whether Martina has scholarships and grants, or whether she has to pay the full cost herself, which might require student loans. How should Martina decide which university to attend? Some of the criteria she should consider are the student-to-teacher ratio, the qualifications of the professors, the types of organizations and clubs available, job placement services, and the school's location. These factors and many more will contribute to Martina's experience and could affect her probability of graduating from college and landing a good job. Martina thinks public university is a better choice for her. It's a good fit with high-quality faculty, lots of organizations and clubs in which she is interested, excellent job placement services, and a convenient location. And because the cost is lower, the return on her investment is likely to be higher. So now she needs to determine how to pay for her education. Along with scholarships and grants, she can use a combination of these methods: pre-funding, post-funding, and funding from current earnings. Pre-funding is saving money ahead of time. Post-funding means taking out student loans that must be repaid after graduation. And funding from current earnings is paying for college with the income from a current job. Martina is lucky that her parents started saving when she was younger. They opened a college savings account under her name and contributed money to it annually. However, the amount Martina's parents saved is not enough to cover the full cost of college, so Martina will need a loan. She could acquire a federal loan or a private loan. Federal loans are made by the U.S. Treasury and have slightly more flexible repayment plans. Martina found good information about federal student loans at this site, studentaid.ed.gov. Private loans are made by private banks and have slightly higher interest rates than federal loans. Using her college savings with a college loan, Martina can pay for her tuition and room and board. But she'll have additional expenses such as books, gasoline, and personal spending money. She's decided to look for a part-time job that gives her the flexibility to attend classes. By thinking through all of these considerations, Martina can earn the degree she wants at a reasonable cost. College is an investment, and there are risks. Making careful choices about what college to attend and how to pay for it reduces the risk. And college pays off. Those with a college degree have greater lifetime earnings than those with a high school diploma, and they are less likely to be unemployed. Visit stlouisfed.org for more information on these and other economic topics. Continuing Feducation is brought to you by Econ Lowdown.